My name is Wendy Knudsen. This is my final presentation for our family finance class. So I decided to do me and my husband in the future for this assignment. So hopefully about 5 years in the future. So my husband, he goes to UVU, but by then he'll be graduated with a degree in digital marketing. I'll be long graduated and teaching, hopefully in Canyon School District. Now that we're both graduated, we're looking to start our family and to buy a house so we can have space and also so that we can get a dog. Currently our financial situation, we have an income about $70,000 a year, which makes it about $5,800 a month. So with that, using the 25% rule, we'd have a mortgage budget of about $1,450. No student loans or car loans are there, so there's no outstanding debt. There is the 10% for tithing each month. And with that, they've saved up a down payment of $25,000. So for their home, they kind of hope to be in the Salt Lake area, more South Salt Lake. And right now they're just looking for a home to start, so not their forever dream home, but just something to begin building equity and credit as they pay off and investing in a home. So they're looking just for a townhome or a duplex, where it's cheaper and smaller and shared, but still their own, hopefully with 3 bedrooms and then some yard space for their dog that they want to get. So this is the dream home option. It is a townhome or duplex, and it is $285,000 a month. And with interest, that'd be about $1,361 monthly. That's just principal and interest. And it's 3 bed, 3 bath, and it's where they want to be near family. This is the modest home. It is a bit cheaper, $1,193 a month, including the interest. More bedrooms, bigger backyard, bigger in general. However, there is renovations that need to be done that could end up making this a lot more expensive than it looks. And also it is further than they would like to be from work and everything. So this is the budget and savings plan. I worked into the budget the 25% instead of their current rent, which is about $700 a month. And also a couple more things have been edited just to fit their needs. So transportation costs is about the same. They still spend the same on gas, and they still have no car payments. And they do invest a little bit. But with the emergency fund, monthly expenses, if you bring down to what's actually necessary, it's only about $4,000 a month. And then for the 6 month, I decided the amount they would save was the average between 3 and 6 months, just because with both Wendy and Brady working, then it is very unlikely that they will have urgent need to be using that as their sole income. So I felt pretty confident with doing the average of the 3 month and 6 month. And then with the down payment option, right now what they can afford is the 10%. That's what they have saved up. Ideally, just from what we've learned in this class, they want to save up 20% just so they can avoid that PMI, because with that they won't be able to afford either of the houses with the back end rate. So with that, their total savings goal was $67,856. I do have in the budget that their long-term savings is $700 a month. I did, for this, calculate in the difference between the rent that they're paying and the mortgage that they can afford, just because they're not paying that mortgage right now, and they will be saving that and investing it in to their long-term savings. As for where they're going to put it, I decided that a savings account would be best, even though it does take a little over a month longer, just because that hasn't a lot of time, but also it needs to be accessible funds in case an emergency does happen, or they do save up the amount to purchase a home, or they do purchase it a bit earlier and use some of the emergency funds for that. So I just think it's ideal to just keep it in the savings account and start building that. This is just the logistics of a mortgage, about how a credit score and a mortgage rate have a negative relationship. So the better your credit score is, the more you pay your bills and you're on top of things, and diverse credit that you have, the lower your interest rate will be, which is good. So you kind of want to stay on top of that. And the mortgages have two different terms. There's the 15-year and 30-year. Typically 15 years have a lower rate. When I was doing my research on it, it wasn't too drastic, but it was enough to make a little bit of a difference. And then most loan places require you to have at least a 3.5% down payment, and that's as low as you can go. That's not optimal though, because up to 20% you have to pay for the mortgage insurance, and that is very not beneficial. So for my family, we decided to have a 20% down payment with a 30-year mortgage, just because it is monthly more affordable, even if the interest does end up being a bit more. So these are the taxes. With the new tax, the standard deductions is $24,000. And what I found was, even with the mortgage rate and the property tax added onto it, the itemized deductions didn't even come close to the $24,000. It was only like $10,000, with maybe a little bit more with tithing and the medical. So even with the houses, it's going to be more beneficial for them to have the standard deduction, which means either way, their liability is going to stay the same, about $4,300. So this is the homeowner's insurance. Monthly cost is about $50.82. From here on out, I kind of chose to stick with the modest home. The dream home's nice, but it just wasn't ideal for payment costs, especially with the down payment that they currently have if they don't end up saving up. So this is for the modest home. And so for transportation, both of them own their cars completely. There's no outstanding debt, and they spend about $120 on gas each month between the two of them, and that's in the allotted into the budget under transportation. And then there's about $80 more in there for just the wiggle room in case something happens. There's some space, or for I forgot what it's called, oil changes and stuff like that. And then insurance is allotted into the insurance category of and it's about $100 a month for both of them. Other than that, the only long-term debt they have is 10% of their annual income for tithing, and that amounts to about $580 a month. So for the debt and for all that, the family's gross income is about $5,830 a month. Their long-term debt, like I just said, is only tithing, which is $580. So calculated, I just times 5,830 by the 36%, and that comes out to be about 2,000 and something, and then I just subtracted out the tithing from that. And that got us to about $1,519 to stay within that rate. That is just less than $10 below the modest home option at this point, because right now the PITI for the modest home is about $1,528, but with that they have to be paying the PMI, which is almost $200 a month. And they'd have to be paying that for about 114 months, or about 9.5 years, which is a lot. So at this point, they would be over, for both houses, they would definitely be over the 36%, unless they can get that down payment to above $20,000. Okay. Yeah. Then the total interest paid for the modest home. I kept them both at 4% because I noticed that the interest for 30-year was usually about 0.15% above, and 15 was about 0.15% below. So I just kind of kept it average because it depends on a lot of things. So I just did the PMI times the amount of time, and then you can see that on the first number, and then I subtracted out the principal value, and that's how many dollars of interest. So you can see it is a drastic, almost $100,000 difference between the interest paid between the 30-year and the 15-year loan. But on top of that, you also notice that the monthly payment is about $600 more. So with the investments, the only way I really knew how to do this was to compare the modest home and the dream home together. The difference of monthly payments between them was about $167. And so that ended up being, if I invested that difference, that would end up being, after 30 years, $411,000. Which is more than the difference between the appreciation between the dream home and the modest home. So the modest home is a pretty good investment if they use the difference of the money to be actually invested and stay on top of that and invest it in a diversified account, and then you will end up with more money in the future. And then just pros and cons of renting versus buying. Right now the family is renting. It is more affordable for the principal rate, and by principal I just mean what they're paying up front each month for it, because they don't have to worry about maintenance costs, or there's no home insurance or taxes that they're paying with that $700 a month. So it is definitely more affordable and something that they can handle right now. The cons is they are just ready to be more settled, and as they're starting their family, there's not really a lot of room in the apartment. The apartment they're renting isn't really the most stable. It is just another family that's renting it to them, and it's not as close to the ideal location as they would hope. And for buying, the pros is that just kind of the opposite. They have more room, and they can get the dog that they want to, that they've been wanting for a long time. And they do begin to start building that equity and more credit towards having a house, investing towards their home more than they are renting. The cons, however, is that they do have to pay an account for PMI at this point if they do purchase a house within the next little bit. And there's not much wiggle room in the budget for maintenance, so they will be pretty strapped for cash for a while, and before they sort out the budget, and just some months will be harder than others depending on what needs to be done. And right now, if they buy right now, they are above that 36% allowance rate, which will definitely be increasing interest and other things. So just to conclude, at this point in time, it's optimal for the family to just continue to save, to continue to rent, and just save the money for a couple years until they have that 20%, because otherwise they'll end up spending a lot more money that they can't afford and that they don't have. It also puts them less strained on their budget in general. And as they can start their family